And that's the command that you can type in the command window. So that's Germany, right? And so the mean is actually you can summarize for Germany much more things, but here you summarize. You just want to know how many observations do you have, what's the mean, what's the standard deviation, what's the minimum, what's the maximum, and you see that between 1986 and 2019. The minimum current account balance was minus 1.7 or minus 1.8%. The maximum was plus 8.6%. On the average was 3.5% roughly. Okay, might be interesting to know. You also see that the net foreign assets or net international investment position, which is the second thing, was on average 14% of GDP, but increased. The maximum quite recently was 47%. Now let's do some regressions. So some first regressions. Now, the first thing to do when you're using a panel data set is to tell Stata, look, Stata, we have a panel data set. And then Stata says, yeah, but what is your cross-sectional variable and what is your time series variable? Or what is the I and what is the T? Sometimes you have a panel where you don't have an I and a T, but you have an I and something else. And so this is why it's important to say, to use the xtset command. So the xtset command says, look, Stata, I have a panel data set, and the IFS code, the International Financial Statistics code, which is a number, this one here, is the cross-sectional unit, and the year is the time series unit. And then Stata knows how to interpret the data, because before it's just numbers, right? So there you go. And then Stata says, fair enough, now I know what you mean. You have an IFS code, which the time variable is, so the cross-sectional variable is the IFS code, the time variable is year. Now, let's go into some regressions. Now, first thing is, and let's stop, estimate a linear OLS regression with country's current account balance as a dependent variable and the lagged net international investment position relative to GDP as a single regressor. So the command is this here, reg ... And please note, we're not doing what the IMF is doing, not yet. So we copy that into the command window, and that's what we get. Right, okay. Now this is cool, because we get a coefficient that kind of makes sense. Why does the coefficient make sense? Well, the current account balance is regressed on a constant plus the NIIP. Actually, it's the current account balance relative to GDP, and it's the NIP relative to GDP plus epsilon IT. Okay, now remember, this is the current account balance is NIP IT plus 1 minus NIIP T. Or in our theoretical model, we had bt plus 1 minus bt for the country where they were observing equals nxt, which is the current account, plus bpit plus bsit, and that's equal to net exports plus RBT plus the labor component plus secondary income. Now, this is the coefficient we estimate. The coefficient is 0.05. Now, this is like an interest rate, right? It's like a 5% return. Now, if the coefficient had been something like 349, I would have been concerned. I would have said, wait a minute, what does that mean? If the coefficient had been minus 675, I would have been concerned as well. But the coefficient is something that kind of makes sense in this context. It's not all we can say about, but it's like, you know, you have the current account balance, which is the change of the net international investment position, and here's the net international investment position in there, multiplied by something that should be like that is like an interest rate, or the returns on assets and liabilities. And so the fact that we're estimating like 0.05 is plausible, right? This is now, of course, in terms of significance, it's you know, above all. I mean, it's highly significant. Now, of course, when you're a time series econometrician, then you're getting nervous here because you say, wait a minute, isn't this a dynamic model? But let's postpone that. Now let's include some more stuff. Now add the following variables to the regression. Well, now this is very user-friendly here because I've just taken the command and you can cut and paste it. So I'm adding the output gap relative to world average, the lack of demeaned output per worker relative to top 3 economies, the prime saver share relative to world average, oil and natural gas trade balance interacted with resource temporariness relative to world average, the instrumental fiscal balance, and a variable reflecting institutional quality relative to world average. Now let's do that regression. And again, this is like a very simple econometrics exercise. We copy. The red stuff just indicates what's new about the regression. And let's paste this in here. And that's what we get. Now, this is a big command window and a very small output window, so let's make the output window bigger. All right, now, so what are these variables? Now let me try to have the cake and eat it, right? So let's make this smaller because we have these dreadful names in here. No, don't do that to me. Okay, la la la. Okay, now I think I'm fine. I just want to make this a bit bigger. Okay. All right, so there we go. And let me. Okay, that should be enough. Let me move this. Okay, so we have. Okay, we get the first variable, and this is why the first variable is the net foreign assets. Now we see that once we've included the other variables, it's still significantly. It's highly significant, and it has a coefficient of still something like 0.05. The second thing is the output gap relative to the world average. So there's some countries having positive output gaps, other countries, and again, other countries having negative output gaps, and the IMF computes the output gap relative to the world average, kind of netting out the global output gap. Now, do the size and sign of the estimated coefficient meet what you expected? Well, the output gap has a negative effect in this regression. This is a hard sell for the, as I already said a couple of times, this is a tough nut for the intertemporal approach. Because the intertemporal approach naive intertemporal approach, think about this model that we had on the second day, would say a positive output gap increases saving because people are saving when they're in good shape, such that they have some assets when they're in bad shape. So based on the naive intertemporal approach, we would expect a positive sign, but we get a negative sign. So that's kind of counterintuitive. Now, there is a good old Keynesian explanation that says if people are in good shape, then they want to import more, and that is driving down the current account balance. I hate that because it's a completely ad hoc argument, but apparently it seems to have a bite. The alternative explanation for that negative coefficient would be the country has a positive technology shock, and so output is expected to be higher in the future, and capital is expected to be more productive, and that goes with people making more investment, and that saving less, and that drives down the current account. Now, the next thing is the lag of the demeaned output per worker. This is this thing here, relative to the world average. Now, here is something where you can form an expectation, or where you can say, is that something that you would expect? Now, this is the output per worker relative to the world average. So if it's high, this is a rich country. If it's poor, it's a poor country. If it's low, it's a poor country. So would you expect rich countries to run current account surpluses, or would you expect rich countries to run current account deficits? Or what relationship would you expect between a country's per capita GDP in relative terms and its current account balance? And when you're asked such a question, please always return to CA equals S minus I. So what is the effect of per capita GDP on savings? Would you expect rich countries to save more or rich countries to save less? Really? Why is that? But then they save more. Look, if you live on a banana a day, then saving that banana is very painful. If you live on 5,000 bananas a day, then saving an additional banana is not very painful. That's the simple thing, right? Savings rates should be related to income levels. right, in a positive way. When you're rich, you have more to save. When you're poor, you spend more on consumption to satisfy basic consumption needs. So that should be increasing in per capita GDP. Now, what about investment? Should rich countries invest more or less than poor countries? Why is that?
It's like a reach their optimum level. So the scope of further investment is not as much as developing nations.
Right. I mean, there's a very straightforward argument where you say, I mean, there's much more to invest in developing countries, right? Starting with roads, starting with factories, all these things. But a slightly more sophisticated argument is, you say the marginal productivity of capital is lower when the capital stock is high. So adding more capital generates more output, but not as much as when you have little capital. So that should be decreasing in per capita GDP. As a consequence, CA should increase in per capita GDP. And guess what? That's what we find in the data. Ceteris paribus, we do find that countries having a higher, this is this variable here, higher GDP per capita relative to the world average tend to have higher current account balances. Next thing is the prime savers share relative to world average. So you have, the size of the population which is in prime saving age. I mean, I would have to check what that actually is. What effect would you expect? Positive or negative? That's an easy one. CA equals S minus I. So if you have a lot of savers, what does that mean? CA increases. You save a lot, so CA increases. Now the next thing is oil and natural gas trade balance interacted with what is it? Something. This is actually quite smart. No, it doesn't want to do that. Okay. So let me try that. Interacted with resource temporariness relative to the world average. Now, why does resource temporariness matter? Suppose you're being told that you have tons and tons and tons of oil in your ground, but in 10 years the party will be over. Then it will be exhausted. You invest more? Yeah, I don't know. Maybe I want to look at the savings side. Remember the story I told you about you getting 10,000 euros in just one day, and I juxtaposed it with you getting 10,000 euros every day? I mean, in the first case, you save a lot of it. In the second case, you save almost nothing, right? If you have oil and it's going to last forever, you don't have to save. If you have oil and it's only going to last for the next 5 to 10 years, then you save part of it. That's intertemporal optimization. So we would expect a positive effect on savings. In fact, that's exactly what we get. Highly significant. Next thing is the instrumented fiscal balance. Now, this is this variable here, right? And I hate That's the names that the IMF gives. The instrumented fiscal balance, why instrumented? Well, because they argue that the fiscal balance is endogenous, so we should, instrument it somewhere. So what effect do you expect? Now, what effect is there of the fiscal balance on the current account if people are completely Ricardian? That's what we did yesterday. 0. What effect do you expect? Now, let me come back to this thing. Current account equals private saving minus private investment minus the budget deficit. That's equivalent to saying its current account is SP minus IP plus T minus G. That's the fiscal balance. Now, please note there's a plus. Now, I've made a big fuss about saying it is naive to think that there's a one-on-one relationship, because this would implicitly assume that private savings and private investment do not react. Now, in the case of Ricardian equivalence, that's exactly what happens. If the fiscal balance goes up, SP goes down. If the fiscal balance goes down, SP goes up to a point where there's no effect at all. However, yesterday we had this overlapping generations model, and the overlapping generations model suggested that there might be an effect of this on that because people are not completely Ricardian. So the adjustment of SP is not as strong as the infinite horizon model suggests. And guess what? We get a beautiful coefficient of 0.5, suggesting that people are not completely Ricardian and not completely non-Ricardian. So an increase in the fiscal balance increases the current account balance by 0.5, right? It's between 0 and 1. Again, usually I don't look too much at the coefficients, but sometimes I do. And here, this is a coefficient that makes sense. So it's not, so the naive reading would say the coefficient should be equal to 1. It's not. A Ricardian reading would say there's no effect because this thing adjusts completely, so that would be the hypothesis that the coefficient is 0. What we get is something in between. Finally, we have a variable reflecting institution quality relative to the world average based on the International Country Risk Guide. Now, this is also, what would you expect? Countries having better institutions running higher current account balances or lower current account balances? Now, this is not trivial, right? Think about it. And please don't think, right? Please don't think that a current account, if institutions are good, the current account has to be good, and a good current account is only a positive current account balance. Well, so if the quality of institutions So what is the quality of institutions? It's the absence of corruption. It's the absence of political violence. It's a political participation. It's a functioning legal system. It's the security of property rights. All these things. If the quality of institutions goes up, what is the likely consequence on the current account balance? What would you expect? Give it a try. I mean, now it's like throwing dice, right? Or a coin. Mhm.
So the direction you cannot tell, but then I would think that if the credibility of the institution is good, whatever they're planning, it should be stable.
Mhm.
So you can even have a current account deficit, but it should be maintained in such a way that it's kind of like stable over time.
Okay, let me jump in at what you said. This is going down, and in fact, in the middle of what you said, there was kind of the thing. Now, why should the current account go down if institutions are better? Well, CA equals S minus I. You're right in saying we cannot say much about savings. We'll say people save more in dysfunctional countries or less. It's hard to say. But we can certainly say that I goes up if institutions are better. Right? I mean, how much do you invest in a country where you think that you can be expropriated the next day?
As much as you can.
Now,
Sorry?
when would you really invest in a country? I mean, you build a factory, you incur enormous costs, and then the next day someone shows up and that's
Sorry, I misheard. So if that's the case, then I will be back.
okay. Yeah, right. So there's a thing that says the current account balance investment is likely to go up in countries where institutions are better, right? Because the return to investment is safer in a country where the institutions are better. And so even if we cannot say much about savings, we can say something about investment. So the next thing is, and remember the current account plus the capital account equals the financial account. Now, the financial account is negative if delta liabilities is greater than delta assets. Now, when you're running a current account deficit, you need someone to finance the current account deficit. Forget about the capital account. So, if you want someone to finance the current account deficit, you better offer good institutions. Now, and this is maybe the key argument. The key argument is countries are allowed to run bigger current account deficits if they have better institutions, because international financial markets for obvious reasons shy away from putting their money into countries that they don't trust. It's as simple as that. Now let me come back to current economic policy in the White House. The idea that the United States current account deficit is a sign of economic weakness and that it should be replaced by current account surpluses is economically not very smart. I mean, the reason why the United States has been allowed to run huge current account deficits in the past is because the United States, up to now, had good institutions. So why the heck are people around the world buying US treasuries in large quantities? Because they trusted the American government. So the current American president turning things around, he's A, doing everything to destroy that huge privilege, and B, completely misreading the data. So take Greece. I mean, Greece was allowed to run huge current account deficits when people thought it was, economically sound. And only when it turned out that the Greek statistical authorities and government had lied to international financial markets. That was the igniting spark that blew up the thing. 2009, a new government was elected, said, look folks, we're sorry to tell you, but our government debt is by orders of magnitude bigger than what we told you, then things went, became disastrous. But before, people were happy to buy Greek assets, and Greece was allowed to incur huge liabilities. So to make a long story short, to run a financial account deficit, you need financial markets to trust you. The financial account deficit is reflected by a current account deficit. So the financial account deficit is a signal that the current account deficit is financed. So a current account deficit is only feasible if you have sufficient, your country enjoys sufficient trust. I'm not talking about some sub-Saharan African countries that run huge current account deficits, which are entirely financed by international development agencies, Mozambique or Niger or Chad. But here we have a sample of countries which are not in that group, right? These are countries where current